You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and in today's episode, we're going to be hearing from Shaun Usmar. He is the CEO and founder of Triple Flag Precious Metals. I was introduced to Shaun a few years ago when Triple Flag was a private company. They've since IPO'd in this last year, and I'm bringing him back on the show so he can give us his thoughts on what's going on in the sector, as well as introduce to us Triple Flag. So Shaun, welcome to the show.
Hey, Bill. Thanks. It's good to see you again.
Likewise. And I'm going to just read off a couple things off your bio here, just so listeners can get an introduction to you. You're an international mining executive with over 25 years experience. You were a senior executive vice president and CFO of Barrick from 2014 to 2016, where you helped restructure the company. And you were with Xstrata in 2002 as an early senior executive member of the management team that grew the company into one of the world's largest diversified miners at the time before its acquisition by Glencore in 2013. Is all that accurate?
That's accurate, yeah.
Great. All right. You're running a company that invests in gold, obviously. So let's start off with your gold thesis. When you're talking to an investor that maybe isn't as loaded up in gold like me and some of my listeners, how would you explain the gold thesis?
You know, as a guy, I've had my career working in originally steel and aluminum. I worked in base and bulks and diversified, which I think is kind of unique in our competitor set. And then, of course, I was CFO at Barrick. I think of gold as a currency, and I think of it, particularly in a business like this, it's underpinned through hard assets. It's generating strong cash flow. You're getting exposure to, you know, the price cycles as they emerge, but you continue to invest through it. So it generates strong yield, and at the same time generates a really handy dividend and provides you with all that beautiful optionality without that exposure to the sort of inflation. And if you look at the environment that we're in right now, where some of these markets seem priced to perfection, we get these various shocks. I think it's just prudent for investors to have some gold exposure as part of their overall thesis and portfolio, whether you consider it insurance or something that is, a sensible part of just managing your overall portfolio. I have no idea why people wouldn't do that. So that's really how I look at it from my personal perspective, having really worked in the mining space for a very long time now.
I have a friend in the last month that said to me, they know I focus on gold and gold stocks. And they said, why isn't gold performing better when inflation is so high? Now, I had a hard time answering that one. How would you answer that person?
Yeah, look, I think we're in such unusual times right now, right? When you look at just every little news event and the sort of volatility that's characterized it, I actually think it presents opportunities for people who aren't caught up in, you know, the sort of microsecond anxieties of the markets that we seem to have. And if you take a longer term perspective, it just seems like a very interesting thing. To me, this whole idea that inflation is transient, the evidence seems to really strongly point to the opposite. And you're starting to see it flow out now in the news flow of miners, right? I think just even these recent quarterlies, you're starting to see some clear inflation over and above what we're seeing being reported with, you know, so-called 3 or 4% CPI. The minute you start seeing this flow across into wages, which we are seeing, I don't know how that genie gets put back in the bottle. So I really think that it's going to continue to be a thing that dominates. I think then the market will catch up with that. I think in the short term, the gold price has obviously been affected with news from the Fed, but it's also, there's a seasonal aspect, right? December and January does tend to be a more subdued period, and somehow people come back in the new year feeling different about it. And you often see a lot of strength in the gold price in the new year. You often see these equity windows for miners open up in the new year as well.
What about the first rate hike? Should we see it from the Fed? Do you think that could be a starting gun for a nice gold run?
I think so. And, I think it's kind of why I do think there's an opportunity here to take a longer term perspective on this whole thing, because there's so much noise. You just look at the last 6 months alone, we've seen these sort of peaks and valleys that have emerged. And if you think about just the sheer amount of government largesse we're seeing around the world, clear signs of inflation everywhere, the supply chain disruptions that I think everyone's experiencing in their lives right now, I think the backdrop should really be very good for gold.
Let's talk gold sector. You have experience in M&A, selling a company, and you worked for Barrick, so you were looking for companies to acquire. What are your thoughts on gold sector M&A, specifically next year in 2022?
Yeah, it's such an important question. I think, firstly, gold is one of the most fragmented sectors in the world. It's so fragmented. There's also too many lifestyle companies out there. So my hope is, we've come from a period, understandably, where the gold cycle, and I was, CFO at Barrick, really in there at a time where when I started, gold was $1,250, and the company had lost money for 3 years, and the whole idea was to reset the cost structure, get it to generate positive free cash, and really set the company up for success as the market sort of improved. So I think in 15, we were dealing with $1,050 gold at that period, and we managed to make cash again. We set this thing up correctly. So my view at that point, and my view now, is that there was need for that capital discipline in the reset, but mining company balance sheets are in pretty good shape. I mean, prices have been good. I would like to think, as we've seen with Agnico and Kirkland, that you start seeing some really sensible combinations where there's some natural synergies and there's just a sensible combination. And we're definitely seeing more activity. You saw Pretium recently. Every banker you talk to likes to say with glee about just how busy they are at the moment. So I think that's super encouraging. And I really do hope we see more consolidation and really more value creation for shareholders along the way. I think it's well poised.
So I've been told by people much smarter than myself that there needs to be gold sector amongst the producers, consolidation, but there also needs to be consolidation in the royalty sector. Would you agree with that comment?
Yeah, I totally agree with that. I think it's an interesting one. Very often you see consolidation in mining, which is a forced marriage in some ways by virtue of just circumstance at a point in the cycle, or indeed like people coming together because they see the possibility. In my career, I started off in operations, but then after my MBA in the US, I ended up in corporate finance, worked on deals in Colombia, China, all over. And I worked on the BHP Billiton merger. And, that took 3 attempts over years to get there to create the world's largest miner at the time. So, these dating periods take a long time to, manifest, but they really are important to value creation. So, yeah, I'm really hopeful we'll see more and more of this.
So that begs the question, leads into my question: why another precious metals royalty company with Triple Flag?
Yeah, we got that question a lot. So, and I'd say certainly the conventional wisdom on Bay Street and elsewhere is it's well catered for. You don't need another one. And when you look at the question you just asked, I mean, we've seen quite a lot of new entrants, certainly in the smaller space where the barriers to entry are lower. I think the way they choose to compete is different to how we emerged. And by that, I mean, either there's like a business incubator component or an area where they perhaps generate the property, they spin it out to take back a royalty and they accumulate, and guys do that very well. Others, have a skill set where they've actually acquired existing royalties, slowly build a portfolio around there, less around, shorter term cash flow generation, longer term generation. You've seen quite a few who are playing in that space, and you're seeing gold royalties emerge recently, of course, doing consolidation, which I think is wonderful. We need to see more of that. For us, it was very much more, when I was at Barrick and we were looking to right-size the portfolio, we did a gold stream on Pablo Viejo for $610 million. There's only 3 guys who can write that check, the big 3. And it was very interesting to be able to see just actually how different they were in terms of their approach. And I'd actually first encountered streams and royalties as a form of financing and the arbitrage on display when I was at Xstrata as co-head of M&A. We bought MIM in 2002, 2003. And at that time, Intel flipped over to look to see if they could stream gold from Alumbrera, which was part of that MIM portfolio. And so that natural cost of capital arbitrage, those gold ounces were in a diversified on part of the core business, but they really were worth more to a business like this one. So coming full circle, we really emerged with a view that the mining sector is actually quite underserved through conventional funding. You get the generalists have really not been around for some time. You've seen a lot of withdrawals for a number of years with various specialist funds. And there did seem to be an opportunity to take this highly customizable form of financing, where if you really had not just the technical know-how, but the commercial know-how, the experience, the networks, the ability to put ideas in front of miners to actually help fund their various priorities, whether it's balance sheet repair, M&A, building the next mine, or just monetizing non-core things, you really could invest through the cycle. And the area that you're competing then is really with just the big guys. You have to be able to write the checks, and you need that know-how and capability. And our view was that the sector is actually underappreciating just how significant those barriers were. So that's really what we set out to do, was to compete at that level, not the sort of lower end. And I think the rhetoric at the time was, well, it's well served, you're not going to do this. We came out to try and expand the opportunity set. And that's really what we've done. I mean, we've seen, I think when we emerged in 2016, it was seen less as a more mainstream form of financing. And I think 5 years on, it's like most people now, when they look at alternatives, are actually considering this. There's more banks that are familiar with it. There's guys who've got more experience with it. And 3/4 of our deals have come about by putting ideas in front of miners and really displacing more conventional forms of financing, giving them alternatives. And I think it comes with better outcomes for our investors as well as the miners in question.
Shaun, I've talked to a number of executives that are in charge of development projects that are nearing a production decision. And they tell me that a lot of the debt sheets that they're presented by lenders are totally predatory, and they wouldn't do that to protect their shareholders. But at the same time, they got to find the capital to bring the asset into production. Can you talk about, from your perspective, when you give catalytic capital, how can that be beneficial to the developer, soon to be producer, as well as producing shareholder value for your shareholders?
Yeah, it's actually such a good question that people, I think, don't really appreciate. It's really that if people have the know-how and the ability to structure these things well, it needn't be an either-or prospect. So I think to your point, I really encourage mining companies and people to go out and really understand their financing alternatives in a very fundamental way. Because to your point, use the word predatory, and we do see that. Like particularly, we helped Step Gold 4 years ago acquire we put about $28 million in at a time when nobody was IPOing, they couldn't raise funding. And we went in there, we helped them acquire the ore body that they needed, helped them IPO in a market where nobody was IPOing, and we helped them get into production last year, which they did very successfully. And they've continued on. They've just published a fresh rock study. What we found is there's a number of situations where we've come in as part of an overall funding cocktail, where there's maybe a consortium of lenders on a mine development situation. There's some equity, and the stream provides the ability to be fully financed, but it's also super patient. And so the history of this sector. People very often underestimate what can go wrong. And so things often cost a bit more and they take a little longer. When you've got a lot of debt on your balance sheet and things don't go to script, then they're going to those lenders. You're having to get concessions. It's never free. There's all sorts of covenants and that they have to deal with, and they're not negotiating from a position of strength. And usually at that time, their equity is not in a great position. So it's not easy for them to go out and raise additional equity. The stream has the benefit here where it's generally covenant light. What we ultimately want to see, I don't underwrite scenarios that usually are the same as the management teams think they were. They're always more conservative. But we have the luxury of being patient. And as long as they can deliver that and they have the ability to execute and deliver that, and that's all about due diligence, it really does create a great investment with a decent return for our investors. It complements the delivery for the mining team in question. It's actually really helpful in the end for the equity investors and indeed for the debt investors. So to put that in context, think of Continental a couple of years back. They're right at the late stages of delivering their mine. We put $100 million stream in alongside Newmont to sort of last money in to get them into production. And, they did an incredible job. The share price shortly after that went up significantly when, in fact, they ended up selling to Zijin, as you may recall. And even in the midst of the pandemic, Zijin has executed beautifully. They've hit commercial production. And in fact, they're really doing an increase from 3,000 to 4,000 ton a day on throughput, which is beautiful. And we participate in that. So a good deal for us. We really helped them at a certain time. And a lot of that was informed by having done deals in Colombia 20 years ago when I was at Billiton. So it's just such an important question, because I think people don't fully appreciate and really understand how a stream can really be quite complementary to enabling the delivery of new mines and be a good source of funding and create good competitive tension with those lenders, as you said, particularly if the terms are predatory. It's good for people to have choices.
Shaun, you mentioned Franco-Nevada, and Franco-Nevada would have never become Franco-Nevada today if it wasn't for exploration upside that discovers more gold. So when you're looking for possible investments, how are you balancing buying current production or near-term production with giving yourself exposure to exploration upside?
It's such a good question because, look, strategically out the gate, we felt that it's important to be able to generate hard cash, good optionality, and scale. So what that meant is really prioritizing, targeting operating assets and things where typically if you're writing large checks, and our check size notionally was saying we'll do smaller and we have done bigger, but it's usually that sweet spot in the $1 to $500 million range where we see good opportunity. And, if you're doing deals, and we've seen the largest precious metal stream, for example, in the 5-odd years of our existence, we did in Australia with North Parkes last year. That really moves the needle for a company our size, but it doesn't really do that much for the guys who've gotten so big at this stage. So we're really in that beautiful sweet spot. We can compete. We've got the scale and diversification. But to your point, you need to still have those things that with patience and time can really create sort of outsized opportunity and reward for shareholders. So that comes in a few forms. I think firstly on operating assets and things that are near operating, which as I said was strategic priority. It means having the discipline to not cap streams because otherwise you're giving away the upside. So we don't do that. It also means that you really need to maintain the discipline and negotiation around gaining exposure to overall land packages, because it doesn't help if someone puts a drill bit in just outside your stream area or where you've got a royalty. They discover the mother lode and you don't get to participate. So to put that in context, I mentioned Continental. Part of that negotiation was originally all the exploration property was off the table. When we did the deal, it got included. And so that mine now, where we put $100 million in 2 years or less than 2 years ago, we've already recouped $90 million. We've got $10 million outstanding on a mine that's a multi-million ounce mine that's just starting to ramp. And the multi-million ounce reserve on that mine it's only capturing 0.18% of the overall land package. This thing's open at depth. You've got this massive exploration area. It's exactly the kind of optionality, that sort of lottery ticket endowment that you need. So you can look at that on large deals. North Parkes is another example where even though there's more than 500 million tons of resource and it's a mine that's been operating for 25, 26 years, the mine, without putting on any more drill bits in the ground right now, it's so well drilled, they've really got to build the capital plan as they work forward, and there's decades of mine life. All that infrastructure is associated with 26 square kilometers. The overall land package that we have exposure to is over 1,000 square kilometers. So at some point, decades from now, when they need to prove up more resources and more reserves and they put the drill bit down, we'll participate. Our shareholders will participate. And then over and above that, we have from time to time picked up, just some small portfolios where usually there's, one or two value drivers, and you almost get those other royalties, essentially not for free, but for very little value. We don't very often compete for these, small royalty portfolios because there's a lot of guys looking in that space. So we struggle for fundamental value there. But a good example would be, we did the minutes in Terra, did the Orica transaction. I was in front of Scott. We managed to get exclusivity. We worked with them. And the two big value drivers in a larger portfolio were Young Davidson. They've just done the lower zone time. They've just hit record production this last quarter. We love having that royalty. The other one was Fosterville. And this was before the Swan Zone had sort of really manifested itself. So for us there, we noticed, interestingly, that the analysts following Kirkland at the time were modeling an 11-year life of mine at Fosterville. The same analysts following this non-core part of Centerra's portfolio were modeling 4 years. And when we did fundamental work, we built 3D models and looked at the drill holes. We did the whole thing. And what we could see is with very limited down dip extension there, that there was a way to underwrite something there, which was not 11 years and maybe slightly more than 4. And just the last 2 years of ownership there, they've already exceeded what we underwrote by 50%. And they continue to find more, and they're doing a beautiful job. So, and then in the meantime, you get those other royalties that kind of come along for very, very little value. So it's a long answer, but that's really how we've approached it. We'll continue to pick up the singles as we find them, but most of our opportunity now is still focused on really large scale, high quality, streams and royalties, where we then get that longer term optionality. And ATO phase 2, we announced nearly 100 million of incremental NAV that was announced, a month ago. We didn't put another dollar in. That's another 10 years of life, and that's before further exploration. That's the kind of optionality we like to give to our shareholders.
Shaun, you mentioned you can write a $100 million to $500 million check. So some of my listeners that aren't familiar with your company are like, where is this money coming from? So share about some of your backers and your availability to get cash.
Yeah, so look, for us competing out the gate, part of why I took this on, and we started from a clean sheet. We weren't a bunch of guys who'd emerged with someone else's portfolio, right? So we set out to build this business from scratch, build a team from scratch. It was just me initially. So, Elliott was the key to that. They're some of the smartest money in the world. They've been in business over 40 years. I think when I last looked, they made something like a 13.5% cumulative, annual return, with about a third of the volatility of the S&P. And I think they had 2 down years in over 40 years. And that included the financial crisis, which was a single-digit down year. So it's like a super impressive track record. And they love gold as part of the exposure. Going back to the start of this conversation, it's just sort of a prudent exposure to have. So what drew me to them was you had a group here with an impeccable track record who really can deal with uncertainty and ambiguity, which I think most resource investors, private investors kind of struggle with. But crucially, they had the firepower and they have an infinite time horizon. They're not a bunch of guys who have a fund that sets in 6 years. And so they maybe have to sell out of that thing and make a bad decision at the wrong time of the cycle. That's bad for them potentially. And it's certainly bad if you're looking to have equity in a vehicle like this. What Elliott allowed us to do, and there was never a blank check. We had to go for every single deal on its own merits. And we generate value by, creating a return as a management team in excess of our cost of funding. So every buck we spend, whether it's our salaries or office rent or on a transaction, you have to make a return on. It's a simple concept, right? And that's really, you'll see our team now owns over 5% of the company. That's been earned that way. But Elliott allowed us, and we had a 5-year plan to see if we could demonstrate that we could successfully compete, build a good business, and then get to a point where we would increase our ownership base. And so that's really what they've done. They've been a perfect, impeccable partner, a super sophisticated, demanding partner, and they'll continue to be sort of disciplined. And look, we IPO'd, you mentioned earlier on, I think it's the largest TSX mining IPO since 2012. We've got 13% more on really blue chip investors on the register, and we'll continue on that growth. But we've got, to your point on the money, we've got no debt. We're generating run rate now 30 million or so of free cash a quarter. We continue to grow. We've had the highest growth rate in the sector the last 4 or 5 years. And we just put out a 5 and 10 year outlook. You'll see more growth there. That's essentially fully funded. And our credit facility is undrawn. It's $500 million. We've got 100 million accordion in addition. So we've got well over 600 million of free cash. And then if there's opportunities to deploy equity sensibly, we don't take dilution lightly. But if we're growing, we just have a strategic alternative as a public company we didn't have as a private one.
And what stock exchange do you trade on, and what's the ticker?
Yeah, so we're on Toronto currently. It's TFPM, and we've also got a .U US dollar ticker to offer our investors that flexibility. We'll look to list most likely in the US next year by MJDS and just expand that base. And other than Elliott and our management team on the IPO, look, most of our investors have it's been a good mix out of Canada, United States, and out of Europe. So we've got a very good base that we've picked up.
Well, Shaun, thank you for providing your comments on the sector as well as an introduction to Triple Flag. To learn more, you can also go to the company's website, tripleflagpm.com, and I will also put a link to that in the show notes. Shaun, thanks for joining me today.
Hey, Bill. Thanks so much. Good talking to you.